What is happening, everybody? We had, little technical difficulties there to get started, but I think we've got it figured out. I think. I don't know. Gene, can you hear music playing in my background? That might be causing problems. Yeah, I'm sure it's an issue on my side. Um, yeah. Okay, so what I'm going to do, I'm going to close this. Give me one sec. Stand by. We're all here. We're all here. Quit. There we go. Okay. Gene, you still have me, right? Okay. We've been having all kinds of technical difficulties. Wasn't my fault in the beginning. Now it's my fault. Now it's my fault. Let me bring this thing back up because we were having all that noise. Okay, so now you can see that chart. I think we're good. All right, so this is what are my options, guys. Again, sorry for the delay. We're all just discombobulated here. This is a show. This is essentially office hours, right? This is for anyone who has any questions about options. If you're thinking about some trades you might want to put on, if you have questions about how strategies work or how to implement certain strategies, that's what we're here to talk about. So there's no plan. There's no nothing scheduled here. We're gonna talk what we need to talk about. So let me just bring up the I got to bring up the YouTube chat here so that I can see your questions. Because in the chat, guys, if you have any questions, put it in there. Okay, I've got it up. I see you, Risky. I see you. I saw you in there, Jay. I see you, Dan. Good morning. Good morning. A couple questions came in already. And before we talk about Uber and ETHA, which is the Ethereum options that you guys were just chatting about in there, I want to mention or address somebody that was in my All-Star Options chat that mentioned something just a minute ago while we were waiting through this delay. Somebody said he's having a hard time controlling his emotions. Uh, what was the exact word? Yeah, he's just controlling his emotions because he's feeling like, you know, the market has been running for a while. He's probably sitting on some good gains, and it's natural. It's natural for all of us, myself included. I fight with this all the time. When I'm in a bunch of positions and they're all working, or many of them are working, I'm sitting on some big open gains. You get that little itch about, oh man, should I take these gains now? I'd hate to give these up. I'd hate for everything to roll over on me. And believe me, I've been there a million times. Maybe not a million, but certainly feels like it, right? Every time feels like a million times. Because whenever something rolls over on you, it's so easy to beat ourselves up with the woulda, coulda, shouldas, right? Like, man, I had that profit. It was right there. I could have easily taken it, and I'd be so much better off had I done that, right? Well, here's the thing about that kind of thinking. Hindsight is 2020, right? We can never know the future. We don't know what the future holds, all right? And I know that taking profits on a big open position feels good, right? It feels good. But I don't know. In my experience in trading and now 27 years, I think that the actions that feel good are generally the wrong actions, right? If you're pulling the trigger based on feelings, you're more often than not going to be disappointed with the outcome. The thing is, when you're sitting in open wins, open profits, especially in trades, maybe I'm not necessarily talking about a trade that has defined upside, right? Like a call vertical spread, right? Where you have unlimited or you have a capped upside. But in trades where you have unlimited upside, let's say you own stock or you're long calls, right? Where the sky's the limit, it only takes one of those trades to really truly go to the moon to make your year or make your month or make your week, right? And for all the times that you take profits, or let me back it up. If you fight those urges to take profits when you're getting itchy about it, right? Yeah, you're going to wish that you took them more often than not. But every once in a while, you're going to get that big win that just makes it all worth it and then some. I'm totally cherry picking this thing, but we have to talk about this stock here. This QMMM. I didn't trade it. I had nothing to do with it. But I mean, this thing not a perfect example? Let's pull up an intraday chart. I don't know if you guys saw this thing yesterday, but this thing was wild. This is an intraday chart we're looking at. This is a 5-minute chart, 5-minute bars. Market opened right here, 7:30 my time. I'm in the mountain time. And this thing had a nice run. It opened around, 11, 12 bucks. It traded up to 20. Look, if you're in a trade where you're up, where you bought it at 12 and it's up at 20 now intraday, I mean, yeah, it's very tempting to take that profit. Of course, this thing rolled over pretty hard and you would have got steamrolled. But let's say you bought this breakout here. This was around 10 o'clock, so around noon Eastern, right? Let's say you bought the stock here at 19, 20 bucks, right? 19 or 20 bucks. When you get up to here, you're thinking, holy cow, I just doubled my money. This thing's at 40 bucks. I gotta take profits here, right? Well, do you guys see what happened? This thing went as high as $300 a share. This is unbelievable. Now, this is a cherry-picked example, and this is a very compressed example. This is an intraday example, but we've all seen daily charts that look like this, right? That every one of these bars represents one day, and so this move happened over the course of a month, right? We've all seen these charts. And while, there's nothing wrong with buying something at 20 and selling it at 40 and doubling your money, that's great. But what if you had held and gotten out, up here at 200 or up here at 250 or up here at 275, or even if you held through this chop, right? I think this stock was probably halted. Even if you held through the worst, even if you got out at the worst price after the peak, which would be like the low of this bar right here, the low print of that bar was 81, right? So if you bought it right here at this breakout and you paid 25 bucks for it, let's say, your worst exit, had you continued holding all day, was 81. Probably you did a hell of a lot better, right? The only reason I'm bringing this up, guys, is because it's emotions are something we have to deal with, right? Emotions are real. I know that there's a lot of pop psychology out there that says that we need to become robots as traders. We need to ignore our emotions. We need to be so programmatic and so robotic and so systematic in how we do things, and emotions will just get us in trouble. Well, listen, I agree that acting on our emotions is problematic, but trying to have zero emotions is A, impractical, and B, a bad idea. All right. Having emotions, A, proves that you're human, or just not A or B, just having emotions proves that you're human, right? And emotions can be signal. In fact, I'm trying to spend more time paying attention to my emotions around my trades, because I feel that maybe it's earned over 27 years of trading, but my intuition kicks in when I'm starting to feel certain emotions. And I don't necessarily know what that means, or what, or why my intuition is telling me certain things, but my emotions trigger my intuitions, and my intuitions, I'm finding, are something I should listen to more often. So let that be an invitation to you to listen to your emotions a little bit, see what your emotions lead into your intuition, see what that finds for you. But don't beat yourself up for having emotions. Having emotions is a good thing. All right. So let's get back to what we were talking about here. There are some questions in here about Uber and ETHA and CCL. I bought CCL today in my another account that I own, or not CCL. Sorry, I bought what was it? What's uh, the uranium play? It's not CCL. It's oh yeah, it is CCL. Hold on a sec. Yeah, because I'm looking at an intraday chart. That's what's confusing me. Let's go back to my daily charts. I'm all confused because I'm looking at things I'm not used to looking at. I bought this CCL today. I don't like the way it's acted since I got in, but I did get into it. And what's the question about it? What do you think about dip on CCL earnings 930? So earnings are 930. Look, let's bring up a different chart here. Let me switch over to my platform that shows my implied volatility. And of course, I'm going to do this and refresh it. Okay. CCL, not Carnival. CCJ. Sorry, CCJ is the ticker I'm thinking of, guys. I'm so confused. This whole technical difficulties throwing me for a loop. It was CCJ that I bought today, not CCL. I apologize. But let's talk about CCL, because that's what you're asking about. CCL wants to know what do I think about buying CCL ahead of earnings? Well, here's what you need to know. And I'm not against it, okay? I'm not against buying CCL ahead of earnings. But one thing you need to be aware of is look at the bottom of my screen here. This is the implied volatility chart. Okay. Implied volatility is not alarmingly high, but it's been rising pretty steadily since early August, right? It's been rising. What that means is that call options and put options are getting more expensive for a number of reasons. The biggest reason probably being that earnings are coming up. Earnings are a binary event, right? We've all seen big earnings gaps come out of an earnings release or an earnings conference call. And so options market makers are not stupid and they price in that risk, right, of a big gap. And so if you wanted to play CCL, um, I mean, I'm not sure if you're bullish or bearish here. I mean, to me, this looks like a pretty bullish chart. The dip looks like, something that could be a gift if you want to get into this thing. Um, I would probably play this. Well, let's look at the options chain. Okay, let's look here. Uh, an earning like if you're just doing an earnings play, right? Because that's what since you mentioned earnings, I'm thinking that's what you want. Then you probably want the options that are right after earnings, which in this case would be the weekly options, October 3rd. Okay. An out of the money call, or just a slightly out or an at the money call 31 strike costs $1.60, which doesn't seem that crazy to me. Doesn't seem that high. Okay. And in fact, as I look further down the spectrum and look at some of the more out of the money calls, it does appear to be a bit more expensive, or I'm sorry, a bit cheaper. So, I was going into this thinking that I would probably want to buy a bull call spread. Well, I guess it depends on your time frame, right? If you're going to do the options right after expiration, or right after earnings, you're really just playing for an earnings bet, right? Then you want to do these October thirds. And there's not a whole lot of juice once you get a few strikes above, a few strikes out of the money. So like buying the 31s and selling, like say the 35s, you're only going to get 36 cents, 35 cents for those. Doesn't seem worth it. I would just buy the calls if you're bullish, right? I would just buy these calls. Maybe buy the 31s or the 32s. Or if you wanted, I talk about a lot of times when I'm just buying calls, I like to buy the 25 Delta Strike, not because there's anything magic about the 25 Delta Strike. It's just that I like that I get a fair amount of leverage if I'm right, and it's cheap if I'm wrong, right? It's going to cost me, if I pay the offer here, I'll pay 56 cents. If I lose 56 cents and I size my position accordingly, no big deal, right? Um, so generally speaking, the leverage is nice. So in fact, now that I'm thinking, as I'm talking through this now, I think maybe buying those 25 Delta calls, which is the 34 strike, and paying less than 54 cents for them feels like a good trade to me. All right. Limited risk, right? That's the most I could lose. That's great. That's like the best feature about options is being able to put on trades where you can define your risk. All right. So putting that trade on, I like it. It's not a trade for me. I'm not sure who asked that. Is that risky business? I'm not sure if that's a trade for me, but I don't hate that trade, right? If you have conviction, if you think this trade is gonna continue and break out of this range here, which in my experience, surprises, if you can call an earnings event a surprise, surprises tend to resolve in the direction of the underlying trend. And there's no denying since April 7th, the underlying trend in Carnival Corp, CCL, is up. So if there's going to be a surprise, it's likely to be up. But our risk is defined if we're wrong. Okay, let's go back. Let's talk Uber. Jason was asking about Uber. I love Uber. I love this setup. I'm not in it right now. In fact, you can see I've got an alert set up right up there. There's no magic in that price, 96.78. That's just more of an area for me. But I want to get alerted if Uber gets above that area, because if it does, I'm likely going to get into this trade. I like it. And right now, volatility is cheap. I would probably just be looking to buy calls. I think Jay mentioned the March 120 calls. I love it. March 120 gives you, what does that give you? Like 6 months expiration. And the 120 strike is right here. Cost you less than $3. It gives you a 23 delta. I love it, Jay. I love it, Jay. For me personally, I would wait. I want to see this thing. I mean, certainly I don't like the way it's trading today. If it, maybe if it breaks today's high, intraday high, maybe I would jump the gun a little bit there. But wait till it starts moving your way, right? But yeah, I love the March 120s in Uber. I think that's a great idea, especially with volatility as low as it is. That gives you 6 months of runway. Very good. I see Cool Guy came in here with Lyft. What about Lyft? He says. Well, I mean, The train almost looks like it's starting to leave the station right now in Lyft. It feels like you might be chasing it if you bought it here. Um, Looks like options are a little bit more expensive in Lyft. I mean, but similar trade. If Uber is going to go, Lyft is probably going to go too, right? Although I think that Uber setup is a little cleaner. Um, yeah, given the choice, if I had to pick one, I would go with the Uber. Okay, next up, Jay was asking about ETHA, which I am in one of my accounts. Love this setup. I love this high flag right here. Loving it. I've got an alert here. I want to be alerted if it gets back above 35. Because actually, no, I'm not in this right now. I was in it and I got shaken out. So I'm out of this. I don't have a trade on here now, but I would like to get back in and I'm watching it, man. If you want to jump it above 34, maybe you could even get in. ETHA though is something that you'll probably want to do a spread because the options premiums are expensive, man. We're dealing with crypto, right? I mean, look, if we just look at October, for example, which is only 37 days expiration, if you look at the 25 delta calls, you're looking at the 40 strike, which is almost $7 out of the money. You got to pay $1 for that. So 41 would be your break even if you bought those, right? Not saying it can't get there. It can certainly get there. This is crypto we're talking about, right? Of course it can get there. But if I were to trade ETHA, I would probably do some kind of spread to take out the sting. Yeah, I'd be capping my upside for sure. But at least I could put myself in a high probability trade. So since we were talking March earlier, let's look at March again. Let's look at buying like the 35 strike calls. We'll do a vertical spread by the 35 strike calls. I mean, look at all the premium here in these out of the money calls. I mean, it's rich, right? So we could go far out, maybe just cut this price in half, right? So let's find like a call that we could sell for 3.25-ish. It would be the 47 strike. Okay, so let's do that. Let's craft the 47 strike. So we're buying the 35, selling the 47. It would cost us 320. Okay. Let's analyze this trade, see what it looks like. We don't have that. We don't need that. So here's what the P&L graph of this chart would look like. Okay. We are currently right here. Let me just clean this up. They always add all these little slices in here. Let's get rid of that. So we are right here right now. Okay. If Ethereum were to break out and get up to 46, this spread, the most it could be worth is $12, right? It's the difference between the strikes, the difference between 35 and 47. That's $12. So the most I could ever sell that spread for would be $12. If I bought it today for three and change, and could sell it for 12, that's 4x my money. I probably won't sell it all the way at 12. I might sell it at 10, right? Buy it for 3, sell it at 10. That's 3x my money, a little bit more. That's a good trade. Yeah, I'd be giving up some upside, right? My gains are capped. I can't make any more once it gets above 47, at least on expiration day, right? But that feels like a good trade. Feels like a good trade to me. And my break even, if I were to do this trade, would be right around 38.20, right? I'm sorry, 108.20. No, wait. My math is all screwed up. 38.20 would be my break even, right? So keep that in mind. Let's imagine we just bought the 35 calls instead. Let me bring up the March. March. Let's analyze buying just the calls. Okay. Nope. Analyze is what I want to do. Analyze. There we go. Okay. So let's go to the Analyze tab, Risk Profile. So, okay, if we did the vertical, our break even is at 38.20. Okay, that's important. In fact, let's put a little thing there. 38.20. 38.20. There we go. That's our break even if we just bought the vertical spread, right? If we bought just the calls, right, and just we're willing to pay that premium, look where our break even level is now. It's at 41. Okay, so from 38 to 41, so $3 higher. Again, it could happen. Of course it could happen. It's crypto. But because your break-even level now is $3 higher, that lowers your odds of success. Okay, these are just things you need to think about as an options trader. There is no right way to do an options trade. You just need to know every trade's a trade-off, right? Every trade is a trade-off between how much you're willing to make and how much you're willing to risk. And what are your odds of success and what are your odds of failure? All of these things are trade-offs that we have to live with as an options trader. All right, so Larry's asking me, Sean, are you loading up on getting ready and getting up ready for the end of year run? Larry, I do feel quite loaded up heading into the end of the year, perhaps uncomfortably so. Let's go back over here. Um, I mean, I'll show you. Look at the right side of my column here, the right side of my screen. All these tickers here. All these tickers are tickers I have, or I shouldn't say all of them, but most of these are tickers I have long positions in. There's a few shorts in here. A couple of these are shorts, like Target. I have a short position in Target, but yeah. Am I positioned for an end of the year run? The eight ball magic eight ball says yes. I have a lot of positions on. Um, but I have a lot of positions on because they're working. I'm actively trimming my losers in this portfolio. I'm being very aggressive trimming my losers. I don't hold them for a long time. Uh, but most of the positions I'm in, they're winning. They're winning for now. They're paper gains, right? I'm actively hedging a little bit. I've got some long SPY puts just as a hedge. I mean, they're not perfect hedges. If the market crashes from here, I'll get wrecked like everybody else, right? But I do have some SPY hedges just to help out. Um, but yeah, I am positioned. I do feel like, Larry, that we are setting up for an end of the year run. It's not going to be a straight line. Never is. There's going to be some hiccups. There might even be a 5 to 10% pullback along the way. I mean, who knows? I mean, the next earnings season is usually the most volatile of all the earnings seasons, right? It's just the way it is. It's not true every time, but often it is. I'm ready for anything. I'm ready for a wild ride. I think it's going to be a wild ride. But yeah, I'm in. So Phil says Uber is set up well in Chaikin Analytics. Okay, great. So you're considering the November 95 105 bull call spread, which offers 2.5x risk reward. Can I please get your opinion on that? So let's pull that up real quick. I know we were talking about Uber just a moment ago, but of course I always have to do this. Such a weird thing, but my screen makes me do that. Uber. Let's craft this trade for you, shall we? You're looking at November. Okay. November 95 105 bull call spread. So let's do that. 95 105. So it's $10 wide. And you could buy it now for about 359. Let's call it 360 just to have nice even round numbers. Okay. Let's analyze this trade. Let's open it up here. So this is what your P&L graph looks like. Okay. This blue line is what your profits will be on expiration day. The purple line shows what your profits will be today along the range price. Of course, these are all approximations. They're not set in stone. Options prices change based on a variety of factors, including changes in volatility, changes in supply and demand, of course. But these are all hypothetical theoreticals. But do I like this setup? I mean, I like this setup for the same reason I liked Jay's trade. I think Uber, this chart's looking great. I think it's ready to pop. Obviously, if you're looking in November, oh, here we go. If you're looking in November, you need this thing to happen a little faster than what Jay's trade was. But look, the most you can make in this trade is 640. You're paying 360 for it now, so you could double your money. Actually, no, you can more than double your money. You can make 640, right? So that's essentially a tripling of your money, or not tripling, but you pay 360, you can sell for as much as 10. One thing I should also point out, guys, with bull call spreads, things like this where my upside is capped, I don't generally hold these things until expiration. I try to get out a little bit early. I will generally sell the spread for about 80% of the full value. So if the most of this could be worth is 10, I'll sell it for 8. I don't want to be greedy because at that point, guys, I have unlimited upside, or I've capped upside, excuse me. Meaning if the things are trading at $8, I can only make $2 more from here. Meanwhile, I'm holding $8 of risk, right? If the stock reverses hard on me for who knows what reason, it doesn't matter the reason, but if it does, I'm still holding I'm holding $8 of risk, right? I mean, that's real money. That's my money. That's open P&L right now. That's my money. That's risk. And so is it worth holding the spread and holding out for those extra $2 when you're risking 8? I don't know. For me, I feel like that's just being greedy. Now you might argue that, let's say Uber gets up to, let's say 110. Let's say we're at 110. Let's, in fact, let's put in one of these slices. 110. Let me delete this. The smart traders amongst you, the smart options traders amongst you will say, well, Sean, it's so far in the money at this point that now have theta working in my favor, right? Every day that I hold this position, every day that I hold it and it's all the strikes are in the money, the value of that spread is actually increasing in value. Yeah, I get it. I get it. Having positive theta trades on your side is a great thing, right? You're doing nothing and the stock's doing nothing and you're making money. That's great. And look, if you have strong reasons to believe that once the stock's at 110, that it definitely ain't coming back below 105, then great. Maybe you hold the spread a little longer. But for me, I would rather just take the gain, sell it for $8, sell that spread that could, the most it could be worth is 10, sell it for 8, book the gain, move on, redeploy that capital into my next best idea. Okay. Sometimes, you play with fire when you hold options all the way to expiration. I mean, I do it from time to time in certain trades for sure, right? But when we're getting closer to expiration, I definitely tighten up my leash on my trades. I tighten up my stops for this very reason. I don't want to give back all the hard-won gains that I had earned. All right, so Phil, I hope that answered your question. I like the trade, man. I just, you just got to be, you have to be more precise with your timing, but I like it. I like it. And defined risk. I mean, what's not to like about defined risk, right? I see someone talk about app. One hole talked about app, APP. What a grinder. I got out of a trade in this today. I was long a bull call spread that I've been in for a while, and I hit my profit target. Just like that Uber trade we were talking about. It was a $10 wide spread. I was able to sell for $8 today. I'm out. It was a October spread. I think it was a 520, 530 bull call spread, I believe is what I was in. Sold it today for $8. Moving on, right? Great. But yeah, this app is a great trade. I mean, for those of you with a longer time frame, um, I mean, you got to love this setup, right? Especially if this thing kind of consolidates right here, high consolidation with volatility coming down. It in volatility terms, it'd be cheap to buy calls. Of course, this is a $560 stock, so you might want to do a spread just to keep your cost of participation lower, right? Which of course caps your upside, but limits your downside. But I like this. I mean, maybe it's cleaner to just trade the stock, right? Just buy, instead of risking a whole bunch of money, maybe just buy a handful of shares of stock and just work it that way. I don't know, but I do like the setup. It's a great looking setup. One hole that is a grinder. In fact, app was one of my best trades earlier in the year. We were back here in end of last year. We got in and we rode this whole thing up here, and by luck of the draw, we got out somewhere near the top. I shouldn't say luck, but I know, was it here we got out? I don't know. It was one of my best trades of the year, though. So I think fondly on app for sure. All right, Luke is saying, can you look at UUUU 6 months out? How would I play it? Let's check this out. UUUU. What a ticker. What a ticker. Well, I mean, that's an incredibly bullish pattern here for sure. You got two things going against you, at least. I mean, if it were me, right? If I was to put this trade on, the two things that I see here that I don't like is that number one, I feel like I'd be chasing it a little bit here, right? I mean, the stock was at $6 a little over a month ago, right? It's double that now. Stock's doubled a little over a month. So I would feel like I'm chasing this one a little bit here. So that's number one. Number two, look down here. Options, volatility, high, the highest it's been all year. So you're paying a premium to buy those options, right? So, but let's humor you. Let's look 6 months out. Let's bring up the options chain here. Let's go 6 months out, which is what, March? Well, unfortunately, we don't have March options. We have April options. So we'll have to do that. All right. So April options. I mean, yeah, juicy premiums are way out of the money. So $12 stock and the 20 options, the 20 strike are still asking more than $1.50. So yeah, there's a lot of premium out there. I would definitely do this one with a spread, a bull call spread, potentially. Let's try something here. I'm curious. Let's be a little creative here. I'm wondering if a calendar, no, calendar spread's not good because volatility is high. So never mind. Forget my creativity. Let's do a bull call spread here because we want to take advantage of these way out of the money premium. I mean, look at the options that are, I mean, a double from here in the stock, right? The 24 strike, which is almost a double from here. Let's say the 25 strike, right? It's a double from here. And there's, that 105, if you hit that bid, right? That 105 is just less than 10% premium on the value of the underlying stock. The stock's $12. If you pay 115 to buy this call option, that 115 equals 10% of the value of that underlying stock. And that's at a double from here. Woo! That's juicy. I'd like to be a seller of those calls. So I think what I would do here, Luke, I would buy I'd probably buy like the 15 strike, right? Analyze the buy trade, go vertical, sell the 125s, take advantage of that juicy premium and only pay $1.45 for it. And most of that spread could be worth is $10. So you could easily 6x your money in this trade if you get it right. I mean, if you're buying this thing, I have to assume you think it's going to 25, right? High risk, high reward. Look, these trades set themselves up all the time and they're not necessarily bad. They're just, they're challenging. But then again, I harp on this all the time with options. The best thing of all the features that make options unique, the best feature about options is that you can craft trades that define your risk. So you could put a trade on this stock that feels like it could roll over at any moment because it's already gone up so much. You can define your risk and put that trade on and know that no matter what, this thing could go to zero tomorrow. You know that you're only risking the, maybe $1.50 you're going to pay for that spread. That's it. That's all you can lose. I love that about options. And you should too. If you're an options trader, you should love being able to define your risk. All right, guys. Well, I think we've exhausted the questions and I apologize for the late start and the technical difficulties. We'll get it figured out next time for sure. And I think going forward, I feel like I say this a lot, but I think we may have found our new home Wednesdays at 11 Eastern. I think it's going to be our new start time for these shows. We got a lot of great content on Stock Market TV. We got to make room for everybody. But I think this is going to be the time for us going forward. So I hope you can make it a regular thing on your schedule to come hang out and talk about trades and talk about options and talk about whatever's on your mind, because that's what we're here for, office hours. All right. So folks, if you didn't see it at the top of the chat there in YouTube, I got a couple links at the very top. If you scroll back up, I got a free options newsletter. I write mostly every day during the week and maybe once over the weekend. It's educational. It's related to options trading. It's related to the trader life, all things that I find interesting and relevant to what we do here as options traders. It's completely free. If that sounds interesting to you, please sign up. I'd love to have you reading my stuff and engaging with me and responding to it if you can. And I also have a link in there for All Star Options. That's the service I run here at All Star Charts and Stock Market Media. It's options trading for options traders who don't want to sit and watch the market every tick all day. These are swing trades we're putting on that have, weeks to months to play out, nice and slow and steady. We're playing for big wins. We're playing for high probability wins. We're employing all kinds of option strategies, whatever we think feels best for whatever setup we're looking at. So love to have you on All Star Options. We have a live chat room that our customers are in all day, every day, engaging with me, engaging with each other, sharing ideas. It's all about community, and we all need a little community in our lives. All right, folks, that's all I got for you. Thanks for tuning in. I hope What Are My Options was as good for you as it was for me. Again, sorry for the delay. We'll do it again next Wednesday. I'll be fresh back from my trip to Toronto, hanging out with the guys, and I'll be ready to rock. So we'll see you next Wednesday. But even before that, I'll see you tomorrow. For those of you who partake, the live options jam session happens tomorrow at what time is that, Gene? I think that's at 11 Eastern also. It's at 3 Eastern tomorrow, live options jam session. So we'll see you there. All right, everybody, take care. Be well, trade them well.